For years, I thought target date funds were the perfect investment. Simple, automatic, professionally managed. Just pick the year you expect to retire, invest your money, and let the fund handle the rest. No complicated decisions, no constant monitoring. That's exactly why millions of retirement accounts use them by default. But after learning more about how they actually work, I started to question whether they were really the best option. Eventually, I stopped using them altogether. Not because target date funds are terrible, but because once you understand their structure, you start to see the trade-offs hiding behind the simplicity. Target date funds were created to make retirement investing easier. Instead of choosing individual stocks, bonds, or multiple funds, investors can select a single fund based on their expected retirement year. For example, if you plan to retire around 2055, you might choose a target date 2055 fund. Early in your career, the fund holds mostly stocks to pursue growth. As retirement approaches, the fund gradually shifts towards bonds and safer assets. This gradual adjustment is called the glide path. In theory, it's a simple and convenient solution, and for many people, it works reasonably well. But convenience often comes with trade-offs. Once I understood those trade-offs, I started to rethink whether target date funds were the best fit for my long-term strategy. The first issue I noticed was how generalized these funds are. Target date funds are designed for millions of investors at once. They assume that everyone retiring in a certain year should follow the same asset allocation. But people's financial lives are rarely identical. Some investors have large pensions, others rely entirely on their retirement accounts. Some have high risk tolerance, others are extremely cautious. Yet a target date fund treats all of these investors the same. The glide path is fixed. The stock-to-bond ratio changes according to a predetermined schedule. That schedule might work well for some investors, but it might not match the goals, risk tolerance, or financial situation of others. Another concern is fees. Many target date funds are built using several underlying mutual funds. Each of those funds carries its own expense ratio. Although some target date funds are inexpensive, others are significantly more expensive than building a simple portfolio yourself. Even small fee differences can have a meaningful impact over long periods. For example, paying an extra 0.5% per year might not sound significant, but over 30 years of compounding, those costs can quietly reduce the final size of a retirement portfolio. Because target date funds are marketed as simple solutions, investors sometimes overlook these expenses. Yet long-term investing is highly sensitive to fees. The lower the costs, the more of your returns you keep. Another reason I moved away from target date funds was control. When you invest in a target date fund, you essentially hand over asset allocation decisions to the fund manager. They decide when the portfolio becomes more conservative. They decide the exact mix of domestic stocks, international stocks, and bonds. This can be convenient, but it also means you lose flexibility. For example, if markets drop significantly, some investors might want to rebalance their portfolio manually. With a target date fund, those decisions happen automatically according to the glide path. You don't control when or how adjustments occur. For investors who want a more active role in managing their asset allocation, this lack of control can feel limiting. The glide path itself is another area where opinions differ. A typical target date fund gradually shifts from a stock-heavy portfolio to a bond-heavy portfolio as retirement approaches. The idea is to reduce risk as investors get closer to needing the money. But some investors question whether this shift happens too early. Modern retirements often last 20 or 30 years. That means retirees may still need significant growth even after leaving the workforce. A portfolio that becomes too conservative too soon could limit long-term growth potential. Different investors have different views on this balance between growth and stability, but target date funds follow a predetermined path that may not match every retirement strategy. Tax efficiency is another factor that influenced my decision. When investors hold multiple funds individually, they can manage tax strategies more carefully. For example, they might place certain investments in tax-advantaged accounts while holding others in taxable accounts. This allows for more strategic tax planning. Target date funds bundle everything together into a single structure. While this simplifies investing, it can reduce flexibility for tax optimization. For investors managing multiple types of accounts, that flexibility can be valuable. Instead of using a target date fund, I moved towards a simpler but more customizable portfolio. Many investors build portfolios using a small number of broad index funds. For example, a portfolio might include a total U.S. stock market fund, an international stock fund, and a bond fund. This approach maintains diversification while allowing investors to control their own asset allocation. If they want more stocks, they can adjust the percentages. If they want more stability, they can increase bond exposure. Rebalancing becomes a conscious decision rather than an automatic one. This approach requires slightly more attention, but it offers greater flexibility. Despite these concerns, it's important to be clear. Target date funds are not bad investments. For many people, they are actually a very good solution. They provide diversification, they rebalance automatically, they remove the complexity of managing multiple funds. For investors who prefer simplicity and might otherwise avoid investing altogether, target date funds can be extremely valuable. In fact, for someone who wants a set-it-and-forget-it strategy, they may still be one of the easiest options available. The key question is not whether target date funds are good or bad. The question is whether they match your specific financial goals.
Ultimately, the decision comes down to a trade-off. Target date funds prioritize simplicity. You choose one fund and let the system handle the rest. A self-managed portfolio prioritizes flexibility. You gain more control over asset allocation, fees, and tax strategy, but you also accept more responsibility for managing the portfolio. Different investors prefer different approaches. There is no single perfect strategy for everyone. What matters most is understanding how your investment choices actually work. Target date funds were designed to simplify retirement investing, and for millions of investors, they do exactly that. But simplicity often comes with trade-offs, less control over asset allocation, potentially higher fees, and a glide path that may not perfectly match every investor's goals. For me, learning more about these trade-offs led to a different approach, one that provides more flexibility and control over how my portfolio evolves over time. If you found this breakdown helpful, hit the like button so more people can discover it. Subscribe for more insights about investing, personal finance, and strategies that help people build long-term wealth. And remember, the best investment strategy isn't the simplest one. It's the one that actually fits your goals.